Joint arrangements are defined under IFRS 11 as arrangements where two or more parties have joint control. Joint control exists when decisions about the relevant activities require unanimous consent of the parties sharing control. Topic distinguishes between joint operations and joint ventures. In a joint operation, venturers have rights to specific assets and obligations for liabilities. Consequently, they recognize their share of the assets, liabilities, income, and expenses directly in their own financial statements. In contrast, a joint venture grants venturers rights to the net assets of the arrangement, and it is usually structured as a separate entity. Joint ventures are accounted for using the equity method, similar to associates. The distinction is crucial because it determines the accounting approach and presentation within group statements. Understanding the classification is also vital in exam scenarios where arrangements may include mixed contractual features requiring careful analysis. The topic emphasizes that joint arrangements play a significant role in group reporting because they sit between full control, subsidiaries, and significant influence, associates. For joint operations, direct recognition of assets, liabilities, income, and expenses ensures that the investor reports its proportionate economic exposure rather than using the equity method. This breaks from the approach used for joint ventures and requires careful reading of contractual terms to ensure correct classification. Joint ventures, like associates, require the use of the equity method, meaning that the venturer recognizes its share of profits or losses and adjusts the carrying amount of the investment accordingly. The topic further outlines that IFRS 11's classification criteria must be applied rigorously, considering structure, legal form, contractual terms, and other factors. Joint arrangements also interact with IFRS 12, which requires extensive disclosures regarding the nature of an entity's interests, the associated risks, and the financial effects on the reporting entity. These disclosures ensure transparency and help stakeholders assess the implications of shared control arrangements. Understanding joint arrangements is therefore essential for both numerical and discursive exam tasks. IFRS 12 Disclosure of Interests in Other Entities. Topic outlines that IFRS 12 sets out the disclosure requirements for entities that have interests in subsidiaries, associates, joint ventures, or unconsolidated structured entities. IFRS 12 aims to provide users with information that enables them to evaluate both the nature of these interests and the associated risks. This includes qualitative and quantitative disclosures about the composition of the group, the judgment applied in determining control, significant restrictions on the use of assets, risks associated with joint arrangements or associates, and the financial effects of changes in group structure. In the context of the SBR exam, IFRS 12 commonly appears in discursive questions, requiring candidates to explain the importance of transparent reporting for understanding the extent of a group's exposure to other entities. The standard plays a crucial role in ensuring comparability between entities with complex organizational structures. The topic emphasizes that IFRS 12 acts as a unifying disclosure standard that consolidates disclosure requirements previously dispersed across multiple other IFRS standards. For subsidiaries, entities must disclose the composition of the group, non-controlling interests, and significant restrictions over assets or cash flows. For associates and joint arrangements, IFRS 12 requires summarized financial information, the nature of the relationship, and the extent of the reporting entity's involvement. These disclosures support users in assessing how investments in other entities contribute to performance and expose the group to risk. The topic underscores that IFRS 12 is frequently examined in narrative requirements because it addresses transparency rather than measurement. Candidates should be prepared to discuss how IFRS 12 enhances accountability by preventing concealment of risks associated with unconsolidated entities or joint arrangements. The standard ensures that financial statements present not only recognized amounts but also the broader context in which an entity's investments operate. IAS 27 Separate Financial Statements. IAS 27, as summarized in topic, applies when an entity prepares separate financial statements rather than consolidated financial statements. Separate financial statements present investments in subsidiaries, associates, or joint ventures not on a consolidated basis, but instead using one of three permissible methods: the cost method, fair value through IFRS 9, or the equity method. The topic emphasizes that while consolidated statements remain mandatory for parent entities, IAS 27 governs how investments must be presented when separate statements are produced in addition to consolidated accounts or in cases where consolidation is exempt. This distinction is important for exam scenarios, as candidates must be able to explain when separate financial statements are appropriate and how the accounting for investments differs from consolidation procedures. The separate accounts focus on the parent as a single economic entity, without reflecting the underlying assets and liabilities of subsidiaries or other investments. The topic highlights that IAS 27's requirements ensure consistency and comparability when entities choose or are required to present separate financial statements. Choosing the cost model means investments remain at cost unless impaired, whereas IFRS 9 requires fair value measurement through profit or loss or OCI depending on classification. Using the equity method aligns the treatment of associates and joint ventures in separate financial statements with their recognition in consolidated financial statements, providing a more informative representation of economic interests. IAS 27 also interacts closely with IFRS 10, IFRS 11, and IAS 28 by defining how investments should be recognized outside of consolidated accounts. Although less numerically demanding than consolidation, IAS 27 is commonly tested in discursive exam questions assessing understanding of reporting boundaries and the purpose of separate financial statements. These statements remain particularly relevant for jurisdictions requiring parent-only accounts for regulatory or dividend distribution purposes, reinforcing the need for clarity in the accounting policy choice for investments.